Okay, we're going to take a look at an interesting thing that's going on in during this little mini banking crisis we're having. This video, I'll just warn you up front, it's going to be a bit of an anticlimax because we're actually not going to take action, and you're going to see why. But what I wanted to teach here on this video is when I see a situation like this, how I might look at potential options that I might buy or sell, depending on the situation, to potentially participate in upside without risking a lot of my personal capital. So what I'm going to do here is we'll just do a quick review. So First Horizon Bank is a large regional bank in the United States, and if we go out a little bit longer term on this chart, we can see that about a year ago they got a bid from TD Bank, Toronto Dominion Bank, and it was an all-cash bid at $25, and the stock had this big jump here back in 2022. And then until just a few days ago, we were approaching the buyout price and approaching the acquisition closure of this deal. And all of a sudden, just the wheels came off, right? So this stock is now way, like more than 10 points below potential bid price. And why is this happening? Well, you can look right away and you can see that this deal almost certainly is going to fall through, at least the market's signaling that. And if you look at the news, you can see that U.S. regulators have some concerns about this deal. Also, that there might possibly be some problem at First Horizon where maybe TD Bank doesn't want to buy them anymore. So the fact that the regulators have concerns kind of gives them an excuse to sort of walk away from the deal. Like, we don't know, but obviously there are some significant problems happening with this deal, and we don't know what's going to happen. So now it is possible, sort of the best case scenario is this stock, it could get taken out at the agreed upon price. And, that means maybe there could be at most $10 of upside. And so what I would do is just take a cursory look at options, call options for this stock. So if we look here, what I would do is I would pull up probably options, say, some number of months from now. So I might look at the August month. And then what we're going to do is just price out a few options. So we look here at the 20 strike, and then we work out the math, right? So if you buy a call option struck at 20, and this company might get taken out at 25, then the best you can do is you'd make $5. This option could max at $5 value. And what are you paying for this? Well, remember, we have a bid here of 50 cents. That's what you get if you were to sell it. And this is a wide spread. If you want to buy this option, you pay $1.75. So for each contract, you'd be putting up $175 with the option, with the possibility of making at most $5. And obviously, if the stock never gets back to $20, this option expires worthless, right? So you lose your premium. And, I probably wouldn't do that trade. And then also we could look at maybe some options that are closer to the money, that maybe have more odds of being in the money or actually having value. So we could look at the let's look at the at-the-money option here, this 15 strike. So here, again, if the deal goes through, you'd make potentially 10 points, and we'd have to pay $4.30 for that option. So, again, like you might double your money if all goes well, but, possibly you won't. And so you're risking $4.30 per contract, or $430, for the possibility to make $10 or $1,000. And I mean, I don't know. That's sort of, again, that is not that great a transaction. Now, we could also go out a little further into the future and we look at, say, the November strike. So this is 245 days from now. And then likewise, we can see these same strikes. And it's interesting, these options are they cost less, interestingly. So you can buy the 15 strike further out in time and it's only $3.50. That's kind of weird, right? So I kind of look at this and I think, and actually here we can see the 20 strike. This is the one with $5 of upside. It's $1.35. So this is sort of an idiosyncratic thing where, you can go out further into the future, and generally, remember the rule on options, right? The more time value, the more value to the option, right? Time is money. So have some sort of idiosyncratic things happening. And likewise, the December option, again, is cheaper. So, these are just different possibilities that you would think about. Now, I don't know what the situation is with this bank, and when you see a bank plummet like this, it does sort of put the fear of God into your heart. And you kind of wonder, okay, where really should this thing trade? And what is it really worth, right? And we don't know. So at the end of the day, this would be something I would only do very, very small. I might buy one contract, and actually, as you can see, I'm actually not going to do anything. But what I would usually do when I see a situation like this, just take a quick look at what call options cost, and work out the math. Like, what would be your break-even price for these different contracts? If something looks interesting, you can put down a couple $100, or not, right? And in this case, I'm not going to do anything at all. So, apologies. This video is kind of an anticlimax because there's really no action to take. But you just keep your eyes open, and then maybe some other opportunity comes along. And just remember the dictum from Warren Buffett, right? There are no called strikes in investing. You do not have to take a swing at every pitch that comes your way. You can only take a swing at the ones that you really want to take a swing at. So this is one of these things where we just let the ball go by. All right, that's it for today. Thanks for watching.